Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, with the official jobs data on pause, we'll speak with one economist for an assessment of the labor market. Plus, we'll look at alternative data collection methods for a real-time view on the economy. And as the government shutdown enters its third day, how are federal employees managing their finances if they're not getting paychecks? All that and more coming up on Market Catalyst. Let's take a look at the markets here. We did just have the ISM, the Institute for Supply Management Services number, crossing the wire, coming in at 50. The estimate, Economist consensus, at 51.7, and the prior read was 52. So some deterioration in services activity. And also remember, 50 is that important dividing line between expansion and contraction. So just towing that line now. We'll see if there's any kind of market reaction here. Looks like not particularly when it comes to the Dow, at least not yet. So we're watching for that. But we do see the Dow up about 232 points, about 0.5%. The S&P 500 little changed, and maybe a little bit of a blip here for the S&P related to that ISM. But we'll see how that shakes out. It's up about 0.5%. The Nasdaq just going into the negative in the last moment. We did see some reaction there. So we're going to keep watching that and see how that pans out. We continue to watch what's going on with yields here, which remain not very elevated. 4.1% is where we've got the 10-year right now. So digging under the hood, looking at some of the sectors within the S&P 500, if this is going to behave for me, which it's not. So we're going to move on. It's the first Friday of the month when the BLS typically releases its non-farm payrolls report. However, with the government shutdown, the data is on pause. Joining us now, Torsten Sløk, Apollo Global Management Partner and Chief Economist. Torsten, it is fantastic to see you here, even if we don't have the jobs data to talk about here today. Before we sort of dig into the big picture, I'm curious if you have any first blush reaction to the ISM services number that we just got, considering it came in a little bit weaker than estimated at 50.
Yeah, what's interesting about what just came out is that, yes, the headline number was a bit weak, but at the same time, prices paid, meaning what are service sector companies paying for inputs into their production, actually went up. And at the same time, you also saw employment actually also went up. So this is telling you that maybe the inflationary pressures that are the biggest worry and has been the biggest worry in many FOMC mentor speeches are beginning to show more signs of life, meaning that there are more risks still to the upside in service sector inflation. Because for a long time, the story has been very simple, that tariffs are mainly on goods. That's why goods inflation has been going up. But now the data that just came out suggests that we should still be watching very carefully what's going on with inflation in services, because now service sector inflation is going up. And remember, services makes up 60% of the CPI index, goods makes up 40% of the CPI index. So the higher rise in service sector inflation we just got right now a few minutes ago is suggesting that maybe inflation is going to be more sticky and more elevated.
It's also intriguing to me in this ISM report that the employment index coming in at 47.2, which is below 50, but still a little bit of an improvement. Given that we don't have the BLS date, I mean, how much importance should we put on that number, and what is that telling you?
No, this is very important because we are really flying in darkness at the moment, because the government data is absolutely of the highest quality relative to any private sector data. The challenge, of course, is that today we didn't get non-farm payrolls. We didn't get one side of the Fed's dual mandate, namely employment. And if this continues into the next several weeks, we will also not get inflation. And that makes it very difficult for the Fed when they meet on October the 29th, because then they need to make a decision without knowing the two very most important variables, namely what's going on with inflation and what's going on with employment. So the answer, Julie, to your question here is that it is indeed challenging for markets to figure out what is the true state of the economy when we don't have the highest quality data that we all normally spend so much time on.
Well, we might not have the highest quality data, but we have an awful lot of data that is out there. And you recently came out with a sort of assessment, right? You listed a lot of the other data sources. You tried to figure out, okay, which are the ones we should be watching. What did you come up with? What are you going to be watching most closely in the absence of getting stuff from BLS?
Yeah, this is also very important for investors at the moment, because if we don't get the government data, then exactly as you're saying, we need then to look, of course, elsewhere. And what are other data sources to look at? Well, one very important indicator is the Red Book same-store retail sales. So this is weekly data that measures what was retail sales last week relative to the same week a year ago. So that's telling you what were sales at Walmart, TJ Maxx, Target over the last week. So this is already a good indicator because it comes out every week, every Tuesday at 9 a.m. and tells you something about the health of the consumer. Other indicators, of course, are Open Table has daily data for how many people go to restaurants. You also have weekly data for how many people go to hotels. This comes from Star, a company in Texas. They report what is RevPAR, what is daily rate, what are occupancy rates across hotels across the country. So there is a broad range of indicators that you can also look at, including, of course, ADP, which we got earlier this week for the labor market, that will give you some idea about how the economy is doing. And these indicators are not perfect, but if you take them all together and put at the mosaic and the picture that they paint, we'll still give you some good idea about what is the direction that the economy is flying in at the moment.
Okay, so tell me then, given all of that, and given the government data just stopped, right, a few days ago. So what's your assessment, Torsten, overall? And I ask that even as you pointed out in one of your recent daily sparks, economists have to sort of take a good look in the mirror here because not just this year, but for the past several years, your profession has been predicting some slowdowns that have not necessarily arrived.
And that is absolutely correct. And in particular now, we are literally today 6 months away from Liberation Day. And often you hear the forecast that, well, we're just waiting for the delayed negative effects of the trade war. Okay, now we're 6 months in and we're still waiting. I mean, maybe Godot will not arrive and maybe we will not have that slowdown that we all expected was coming as a result of what happened in April and May, where things, of course, were very turbulent. So maybe we should begin to come to the conclusion that maybe we're not going to see the economy slow down. And what's the consequence of this? Well, the consequence of this is that at the same time, we have upward pressure on inflation from tariffs. We have upward pressure on inflation from a lower dollar. Remember, when the dollar goes down, it becomes more expensive to buy my white shirt abroad. And if that's the case, then the price of my white shirt will go up. So that means that we have also inflationary pressure because of the depreciation of the dollar we have seen. And we also have inflationary pressures because of immigration restrictions. Deportations and immigration restrictions means that wage growth is starting to rise, especially in the sectors where unauthorized immigrants are concentrated, namely hotels, restaurants, agriculture, and construction. So taking these things together, if we already have from the consensus a forecast where the expectation from the consensus is that inflation will be 3% for the next 12 months. Remember, it's supposed to be 2% according to the Fed. That just brings down the conclusion, well, okay, if we at the same time do not have an economy that's slowing down, that means that the upside risk to inflation is even bigger. So in summary, the short answer to your question is, if we turn out to be wrong in the economics profession and the economy is actually not slowing down, well, then I will worry even more about inflation going up and therefore that the Fed should therefore really begin to think more about rate hikes and worrying about inflation being sticky and not coming down as significantly as they have currently in their long-term forecast.
So let's just look real short term then. Do you think that the Fed, I guess it's a two-part question, will cut rates in late October? And do you think they should cut rates in late October?
I think they will cut rates, but I think we're getting to the point where we need to look very carefully at the inflation outlook. I understand, of course, service sector inflation for a long time was going down, but in the last 3 months, it's actually started to move sideways at around 4%. Goods inflation, that has certainly started to move higher, partly because of tariffs, partly because of the dollar going down. So when we put together our Apollo forecast for inflation, goods inflation is certainly moving higher. Partly because of tariffs, because inflation is measured year over year. That means that year over year, inflation will be rising. Service sector inflation, in what we just saw that came out here a few minutes ago, you are beginning to see more upward pressure on ISM services prices paid, which is also telling you that maybe there's a risk even to the upside also for services inflation. So that means that both goods inflation is at risk of rising, and now we're seeing here at 10 a.m. a few minutes ago that service sector inflation is also rising. That brings me to the conclusion that maybe in October, it would be a good time to pause and have a careful look at what are the alternative indicators for inflation telling us at the moment.
Well, and Torsten, let me ask you this as well. As you know, consumer spending has been incredibly resilient this year, even with all of the, sort of headlines and headline risk. What have we seen in the, if inflation is going to be persistent, does that feed back through and depress consumer spending?
Yeah, because the real challenge, of course, is that if inflation starts to stay higher for longer, that is not only the Apollo forecast, that is also the consensus forecast, that is actually also the Fed's own forecast. It has exactly two consequences. Number one is indeed that then, of course, consumers will find prices higher. That will have impacts, of course, on real spending, meaning how much people will be buying. Walmart said this through this earnings season. Well, meaning with the one we had in Q2, we are going to raise prices. And at the same time, of course, we should expect that we're going to see lower sales. So a very important first conclusion is that this will indeed impact consumers, especially more price-sensitive consumers. The other added effect, of course, is that if inflation is higher for longer, that interest rates will also stay higher for longer. And that means that it will still continue to be more expensive to borrow on your credit card, more expensive to borrow on your auto loan. And as a result, we have already seen delinquency rates rise since the Fed began to raise interest rates in 2022. So we are already seeing people falling behind on credit card payments. We're already seeing people fall behind on auto loan payments. And if inflation now is higher for longer, it's just going to take longer before we begin to see some improvement in the delinquency rates across different types of consumer credit. So the short answer to your question is consumers are hit partly by higher prices, which is the direct impact, but also by the indirect effect that the Fed will have to raise interest or keep interest rates at higher levels for longer to make sure that inflation does come down to the 2% that they have been mandated to hit by Congress.
As we know, Torsten, there's been an offsetting effect in the market from all of these sort of economic cross-currents, and that's AI, which has sort of like swept away everything else. You've written a lot about AI, its contribution to GDP, but also market concentration in AI companies. And it's just getting more concentrated. The market's going, yes, there's been a little broadening, but it's still very concentrated here. So what most concerns you about the AI cycle at this point?
Yeah, Julie, and I know you have covered this so extremely well because this continues to be a very important backdrop for the macroeconomic conversation, namely, what does it mean for investing? And when we think about the macroeconomic backdrop, all of us, of course, we immediately begin to say, well, if the economy is accelerating or decelerating, how should I think about the outlook for the S&P 500? But what is absolutely critical in between that discussion is exactly this issue that essentially the AI story now makes up 35% of the S&P 500. The 10 biggest stocks make up almost 40% of the overall S&P. At the same time, earnings have been highly concentrated in the Magnificent Seven. You also have had CapEx spending, including data center spending, has been very concentrated among the Magnificent Seven. You also have returns across the board. The S&P 500 is simply no longer the diversified investment that it used to be because the AI story is so pronounced. And with some of the recent developments, including in the census bi-weekly survey of more than 1 million US companies and asking them, what is your adoption rate? Have you over the last 2 weeks adopted AI? You're beginning to see to this question where companies are asked, have you adopted large language models? Have you adopted voice transcription? Have you adopted readings of documents? And those different types of questions, in particular larger companies, are now beginning to say, you know what? Our adoption rate of AI has begun to slow down. So the real risk to the economic outlook is if the AI story starts to fade, if it is a worry here, which it is for many, including me, that maybe a lot of AI companies are indeed overvalued, then it would begin to have some significant risk when we think about the S&P 500. That is different from the S&P 493, but it certainly means that there's a very, very high concentration in the AI story that's driving the stock market forward, which, to your point, is exactly somewhat disconnected from what's going on in the economic outlook.
Torsten, we'll keep watching to see how that AI story plays out. Great to catch up with you. Thanks so much.
Thank you.
Coming up, alternative data, as we've been discussing, is reshaping investment strategies. We'll talk to one company that's using everything from social media posts to credit card data to map out the health of the economy. That's next. The government shutdown delaying the September jobs report, meaning a lack of official data for investors and the Fed to help gauge the health of the economy. That set off a search for private data sources, and my next guest is aiming to provide just that. Joining me now, Apurv Jain, a MacroX founder and CEO. Apurv, thank you so much for being here. So we've been talking a lot about this recently, sort of in the absence of having that BLS data. Where are people turning? So tell me a little bit about MacroX and where you all are drawing from when you're trying to gauge what's going on in the economy.
Great to be here. I'm a huge fan. So we started MacroX thinking we can count faster than the government by using satellite data, social data, credit card data, foot traffic, essentially combining all these different data to provide this 360 view. What we didn't realize is the government would stop counting. Um, so, uh, so that's been the problem. So what we're seeing, and we're used by some of the top asset managers to essentially get a 2 to 3 month lead on the government data, right? So I can talk a little bit about what we're seeing. Hey, what you're watching here is kind of the platform in action, and it basically enables the users to just see, hey, that's what's coming up next month. They can dive into different models, all those kinds of things. This is our labor market dashboard, which is going to be relevant, and I'll go through that.
Right. So let's talk a little bit about labor specifically, since this is a day normally that we would be talking about the Bureau of Labor Statistics, the government jobs report. What kinds of things are you looking at, and what are you seeing in your jobs data?
So we specifically for job market, we look at things such as social media. We look at how anxious workers are. If they're looking for food stamps, are they really worried about job cuts? Are they tracking layoffs? What's going on there? We look at those, and then we also look at kind of what is the bargaining power of employers? Are they complaining about, oh, I have to pay my workers a huge bonus to retain them, which was the case about 3 years ago, no longer the case, or are they concerned about they do not have enough kind of worker supply because of the immigration crackdown? So we track all those things and we crunch them all together to essentially show that some of the concerns raised actually by the previous guests. So Torsten's a hero of mine. So there are natural concerns about wage growth. So we can tell him the white line, by the way, is the government data that lags kind of our data by 2 to 3 months. So what we can see here is the wage growth is indeed neutral. It is not ticking up, but it's not going down. So essentially the labor market is in this uneasy equilibrium where there's low supply and low demand. The unemployment rate is ticking up, is slowly cooling. So unemployment rate over the last few months ticked up. This month we do not see unemployment rate ticking up. So we estimate the unemployment rate to be 4.28%, which is close to what it was before. So yeah, there's no major weakness. We do see one interesting point I'll make that our data enables us to see is that the overall economy is stronger than the non-farm payrolls, especially the jobs report, especially last month. When the jobs report came out weaker, the market the bond market, rallied. In other words, the market kind of plummeted, the yields plummeted. So what we can tell you is that the growth rate, the GDP growth rate is close to 3%, which is different than kind of a 50K or so payrolls. So the two have diverged distinctly, in part because payrolls are quite noisy and the noise has become really high with two kind of revisions. Kind of the people don't respond to surveys, but then there's these annual revisions done by census.
Right.
So those two have resulted in payrolls becoming super noisy. And we want to say that alternative data tells us that's not the case. The economy is okay, although the hiring is weak.
And I'm curious in particular if you have a read on what's happening with entry-level workers, because I'm hearing anecdotally from some executives, let's say I brought in an analyst class or an entry-level class on the professional level of 10 people a year. This year, maybe I'm doing 5. Next year, maybe I only need to do 2 because those workers I'm bringing in are more productive because they're using AI. Are you measuring that, and is that something that is playing out, or has that been overstated?
That's a great question. So what we do see that CEO hiring intentions, so we track when CEOs talk about, hey, are we going to hire or not, wherever they are, so whether it's an article or print. So we see the hiring intentions fortunately ticking up a little bit from the very low levels, but it is still distinctly below trend. So we would like to see more hiring.
And then what about on the inflation side, which is the other big equation? We don't know if we'll get CPI in a few weeks, right? We don't know if the government will still be shut down. But I imagine you can do quite a lot of survey data on your own in terms
Correct.
of what's happening with prices.
Yes, so we have our inflation drivers. So the two large categories, kind of goods and services. So we are able to look at services depend in large part on worker kind of bargaining power versus employer bargaining power, right? So that's the wage setting. If there's not enough immigrants, do you need to raise wages to essentially get enough workers in? So thus far, we're not seeing signs of that much. So we see it as flat to neutral. We are not seeing services inflation rising over the next 2 to 3 months, which we know is a little bit contrarian view, but that's what our data is showing. We are all in terms of goods prices, we do see a little bit of a tick up. So that's the alternative measures of good prices. We see them tick up a little bit, but we're not seeing this massive acceleration that was feared. So we kind of see like a 8 to 10 basis points rise kind of spread out over the year, and we see that continued pace, but we don't see this massive uptick in goods either. So thus far, we are in the soft landing camp where we think there's still a 60% or so chance, which is much higher than the market estimates of a potential soft landing. There is a lot of noise, obviously, but that's what we see.
Very interesting, Apoorv. We'll check back in a couple months to see how all of this plays out. Really appreciate it.
Thank you very much.
Take care. Well, the AI trade continuing to boost stocks to record levels after OpenAI was valued at $500 billion. Yahoo Finance's Miles Udland spoke to Dan Niles, founder and portfolio manager at Niles Investment Management, about where to find opportunity.
If you think about the short term, we're very bullish on NVIDIA. And the reason is that you don't have any China in the models, and I think you're going to get a license from the US government, given NVIDIA invested in Intel recently, to ship to China coming up very soon in terms of the Blackwell chips. The second part is deals that you've seen, like the $100 billion investment into OpenAI. That's not in the models either for next year. And that gets back to your argument around circular investments. And I want to be clear on this. I think this is all going to end incredibly poorly at some point. But in the near term, much like if you look at after the Telecom Deregulation Act in 1996, you're going to have a lot of these circular investments. Back then it was called vendor financing going on the assumption that all of these companies are going to win. And if you look at where the world is today, obviously that's not the case. Where if you look at e-commerce, how many winners do you really have? You have Amazon. What about search? You just have Google. What about social media? You have Meta. But these days, you've got this circular financing going on, and it's assumed that every AI company is going to be worth $1 trillion at some point. And I think you're going to see it coalesce down to a few players, just like you saw post that internet shakeout. But I think in the near term, Fed's cutting rates, you'll get another one probably October 29th, you'll get another one on December 10th. Easy money is a great drug. It drives markets higher. And right now, I think with NVIDIA, you're going to see the pressure on the stock being to the upside. And then I think, sometime late or mid 2026, that's when a lot of this stuff's going to catch up to you when you're on the other side of a lot of these rate cuts.
Yeah, stocks just about doubled, I think, from those April lows. A name you mentioned there is Amazon, which has been a laggard this year. It obviously has a lot of ambitions within that AI context. What's your view on that story now? And is there scope, I guess, in your view, for them to catch up to, both technologically and in stock performance, what some of its rivals have enjoyed this year?
Yeah, I think Amazon actually is probably my favorite out of the Mag 7 right now for one simple reason. If you look at it, they've been the biggest laggard in terms of their performance in the hyperscale arena from really the beginning of the year. So if you look at AWS, revenue growth in the December quarter was 19%. It dropped to 17% in March, and then it stayed there in the June quarter. If you look at Google by comparison, their revenue growth in the March quarter was 28%. And it went up to 32 in the June quarter. And if you look at Microsoft, it accelerated from 31% in December to 33% in March, all the way to 39% in the June quarter in terms of Azure. And that was powered by OpenAI, which is on their platform. Now, I think that's the interesting part about Amazon. They're the host for Anthropic, and Anthropic has become the coding assistant of choice for most companies. And Anthropic's revenues on an annualized run rate basis was about $1 billion to start the year. By August, it had gotten up to 5 billion. And I think by the end of the year, you're going to be at around 9 billion. So you're going to go from it contributing 1% to 2% of revenue growth for AWS in the first couple of quarters to it should be closer to 4 to 5% as you get into Q3 and Q4. And I think that's going to get that to reaccelerate. And that's the one metric that everybody's hyper-focused on, rightly or wrongly right now, given the AI craze.
Yeah, and I want to get you out of here on a name we don't often talk about on this program. That is Impinj, playing in a slightly different space within that AI trade. But I think we're going to talk about it later in the program. There are just so many different ways that investors can play these AI themes. I'm curious where that company sits within this context for you.
Well, I think with Impinj, if you think about the world, like the 1950s and 60s is when you had the earliest AI internet technologies around. RFID, which is where Impinj plays, has been around since about the 1970s. But I think it's a technology whose time has finally come. Because if you look at where their products are, RFID technology, which is these chips you can put on to track everything, they're up, they're being used a lot at Walmart, at FedEx, at all these companies. But with this new technology that's come out, the MI800, which is on 22 nanometer technology, all of a sudden, these inlay costs are down to like 2 cents each. And so their current market right now is apparel, where it's about an 80 billion unit a year market. That's expanding to general merchandise as you tag everything in the store. That's about a 320 billion unit market. But the real holy grail is, what do we do every day? We eat. Well, the food and drink packaging market, that's over 1 trillion units. And they've started trials at 8 out of the 10 biggest grocers in the world right now. And you're going to start to see some of this translate into ramping pilots next year. And that's obviously 1 trillion is way bigger than 80 billion. And that's going to start, I think, RFID technology. I think its time has finally come. I think this could be the best growing technology company over the next 5 to 10 years. And it's only at a $5 billion market cap today. So obviously could grow quite a bit as you penetrate those massive markets.
All right. Really interesting story there. Dan Niles, always appreciate the time. Thanks so much.
Thank you.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street: Bumble, Levi's, and Instacart. First up, we have Bumble. Goldman Sachs downgraded the stock to neutral from buy. In a note, analyst Eric Sheridan said, quote, uncertainty remains around the company's ability to return to growth in the next 12 months. And it's waiting on further proof points of its turnaround efforts, like enhancing user quality over volume, as well as trust and safety initiatives. Sheridan also said the market environment and investor sentiment for small and mid-cap stocks have become more volatile in recent months, and that could spell bad declines for Bumble, or more declines. And next up, we have Levi's. Ahead of its third quarter earnings report on Thursday, October 9th, Telsey Advisory Group's Dana Telsey raised its price target to $27. That's up from $24. In a note to clients, she said after the company had reported an impressive second quarter and raised its annual outlook, which now includes that impact of tariffs and mitigation efforts, she believes it's well positioned longer term, benefiting from a stabilizing U.S. denim market, a strong direct-to-consumer business, and increased concentration on newness. That stock is up around 40% year to date, and it's moving higher today. And lastly, we have Instacart. Piper Sandler downgraded the stock to neutral from overweight. Analyst Tom Champion said the decision was based on increased competition. And in recent months, Amazon has expanded same-day delivery for fresh food. Uber partnered with grocery chain Aldi, and DoorDash even expanded its partnership with Kroger. Now, Walmart also behind the scenes has been ramping up its own same-day delivery. Its goal is to be able to deliver within 3 hours or less to 95% of U.S. households by year end. Champion also cut Instacart's price target to $41 from $62. The stock right now around $39. Keep it right here on Yahoo Finance. We'll be tracking all the market moves and top calls throughout the trading session.
Now time for some of today's trending tickers. We are watching Apple, Rumble, and Roblox. First up, Apple. The stock was slashed to underperform at Jefferies on excessive iPhone hopes. Analyst Edison Lee writes that the stock's current valuation prices in an overly bullish iPhone outlook, and better demand for iPhone 17 due to a price cut on the base model is already in the stock price. That's led to excessive expectations on the 18 Fold and the replacement cycle. Relatively rare bearish rating on the stock. Fewer than 7% of the analysts tracked by Bloomberg have a sell equivalent rating. But interestingly, the share is not getting hit here. Next up is Rumble. Shares gaining after entering into a strategic partnership with Perplexity to develop a new subscription model combining the pro features of each platform. Today's gains follow a 15% jump in after-hours trading following the announcement. Rumble is an online video network platform that offers help content creators manage, distribute, and monetize their content. And finally, Roblox shares sliding after M-Science analyst Corey Barrett says U.S. bookings growth has decelerated sharply from recent highs. Despite the slowdown in bookings growth, the analyst expects it to remain near recent highs outside of its core markets. Roblox has 25 buys, 7 holds, and 3 sells. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, an expert shares tips to protect your money from the most common online scams. Stay tuned. If you've ever been scammed online, you're not alone. 73% of U.S. adults have experienced some kind of online scam or attack, according to Pew Research. And the latest FTC data shows a big jump in reported losses from fraud, hitting $12.5 billion in 2024. Joining now how to explain how we can protect ourselves and our money from online scams is Michael Jabbara, Visa Global Head of Fraud Services. Michael, thanks for being here. Obviously, this is a big problem. I guess, first of all, let's go through some of the biggest kinds of scams that you all have been witnessing and kind of how they play out. So you sent us a list of the 5 top scams here. Chief among them, a dating scam. How does that work?
So people who are looking to find their kind of lifelong partner and are looking to meet that individual in person want to carry out a background check just to make sure that they are who they say they are. So they get a link from this potential match saying, here's a verification service. You click on it. It'll ask you for your payment information. Don't worry about that. That's just to validate you. You won't be charged. And then you're going to go through that process. And what happens in the background is that your payment information is then subscribed in a whole host of recurring billing services that you didn't sign up for. And if you don't check your statement on a monthly basis, you could be paying, $40 every month for as long as you don't know. So that's one of the more common kind of nuanced scams that we've seen in the romance space.
I mean, I think all of these, as you scan through them, basically prey on people's desire for something real, right? So in wildfire relief, people want to help, right? And so sort of takes advantage of that. The travel scams, you want to go on a trip. So talk me through some of these other ones.
Yeah, no, you're exactly right. Scammers are keen observers of human nature. They know exactly what we want and how they can exploit that for their illicit gain. So for travel, it's summer or you're looking to take a holiday, so you make a booking with your airline or hotel. What happens in the background is that they will kind of mock up the website of that entity that you traveled with and send you an email saying, hey, your reservation has been canceled, so you need to put on a different card so that we can charge you for the balance. And they'll get that information through a combination of phishing, smishing, or get data from the dark web based on all the data breaches that have happened over the last few years.
Wait, I know what phishing is. Did you say smishing?
Oh, smishing. Yes, absolutely. So it's essentially sending a phishing text through SMS, therefore smishing.
Got it. Yes. Well, I've certainly been seeing an uptick in those kinds of texts as of late. So I guess, Michael, are there remedies that apply across these categories that can help people avoid these scams?
I think the key thing to remember if you're a consumer is if you find yourself in a situation where you're being pressured to make a decision because it's an offer that's going to expire in the next 60 minutes, or if you come across a deal that's too good to be true, you kind of need to take a step back and think a little bit more carefully about whether you want to share your personal data or your payment information with this entity, especially in a digital channel. And then one of the things that we've been focused on from the Visa perspective is really thinking about how these network of scammers are operating and what are they using to carry out their schemes, and working with our partners, including law enforcement, to shut that down. So we've seen really strong success over the last year where we've identified over $1 billion of scams across the network and helped dismantle that.
What do you do as these scams get more sophisticated and they're using AI and they're using deepfakes and you're looking at this site and, as you say, it looks like the real site. So what do you do?
So the scammers are absolutely stepping up their game, and that's why we have to step up ours. The only way that you're going to beat this bad application of AI is through greater investments in good applications of AI. So the ability to be able to track these websites and shut them down, the ability to start to look at odd transaction behavior and warn the consumer or warn the bank that this is happening is how we're going to win. Consumers have to play their part. They're the first line of defense. They have, again, to kind of think about they have to put on their common sense cap. But technology is the way that we're going to be able to resolve this issue.
Michael, I think it's also really interesting, going back to something you said earlier about sometimes you get these recurring charges that you didn't know you agreed to on your account, which brings up another good tip, which is, check your account regularly, right? We all have the ability to do that. Are there other things you can do to make sure if there are those transactions that you know about it?
Yeah, you should sign up for transaction alerts. Right? So every time your account is being used, you get a notification on your phone. You'll say, oh, yes, I did make that transaction, or no, I didn't, because early detection is key. So if you're seeing an illegitimate merchant using your payment information illicitly, letting your bank know allows us to kind of gather that data and then aggregate it across the entire network so that we can go and shut these bad actors down. And then the other piece I would kind of recommend is really being careful about your data and how you share it, even within social media. And one of the ways that scammers are being really successful is they'll go and scrape your social media profile for data about you, and they'll create this synthetic that they'll target your family or your coworkers with, and they're more susceptible to fall victim to that. So be very mindful about how you share your data and with who is key.
Michael, has there been every year do we just see this problem increase? Has there been any kind of slowdown at any point in time? And if so, has it been because people are getting more wise to it, or there's been efforts to successfully combat it, or is it just keep growing and growing?
It's growing because you have this democratization of access. So before, if you can think about scams, they were very targeted. It's going to be a romance scam, or a scam that's targeting the elderly, or a scam that's targeting crypto investors, or whatever the case may be. But now, because anybody has access to these AI capabilities that allow them to generate a really convincing deepfake or a really good phishing email, they can target anyone and everyone. So we're seeing folks target small business owners who are looking to start a company with kind of consulting services that they never actually receive. So it just kind of gives you an idea that now there is no limitation on the fraudsters because of how they've been able to scale and target victims in ways that we didn't see before.
Yeah. Thank you. Some really good tips here to try to avoid all of this. Appreciate it, Michael.
Absolutely. Thank you.
Got much more markets action coming up. Stay tuned. You're watching Market Catalysts. Hundreds of thousands of federal workers have been placed on furlough as a result of the government shutdown, now in its third day. That means they, along with essential workers still on the job, will not receive a paycheck until the impasse in Washington is resolved. But they still have to pay their bills and other basic expenses. To discuss how workers can manage their finances during the shutdown, Chris Kowalik is joining us now, founder of ProFeds. And you basically try to help people in all times with who work for the federal government with sort of retirement planning and financial planning generally. I'm sure you're getting a lot of questions right now. So if people are not getting paychecks, what do you tell them to do?
Well, this year has been riddled with lots of questions through the Trump administration in the first couple of quarters of the year. Certainly right now, when it comes to a government shutdown, a lot of this will depend on whether someone is already retired from the federal government or they're still working, of really what happens in that situation for them. So for instance, those who are already retired are still going to get their retirement check. They're still going to receive their Social Security benefits if they're on Social Security. They're going to continue to have their health insurance and their life insurance available to them. So none of those things change. But for active employees, that's where things get a little bit different. With them, when they think of the paycheck that should be hitting their checking account every 2 weeks, they are simply at risk for not receiving that. And so the normal bills that they typically pay with that money that comes in every 2 weeks, those bills might be a little bit harder to pay for those employees. But I do have some good news. The good news is for those employees who are furloughed during a government shutdown, they're still going to be paid. There just may be a delay in when they actually receive that payment.
Do you see an uptick in folks doing things like taking out short-term loans, payday loans, when this kind of thing happens? And is that, what would you advise people should do?
Most of the time, what we see is the high interest credit card debt spending, which is always a concern. Anytime we're thinking of high interest credit card debt, high interest loans, those types of things, that always worries us because that tends to put people in a bit of a financial spiral in the wrong direction. And so we really encourage folks to have an emergency savings account to be able to manage those times when perhaps the government does shut down. And I'll be really honest, when we're thinking of all of your listeners, emergency funds are always important to make sure that whatever that comes up, they're able to weather that financial storm and not be stuck into making decisions that otherwise they wouldn't do in normal economic times.
Right, and I guess federal workers in particular, because unfortunately, this seems to be happening with some regularity, so it's at least a possibility. When you are giving sort of more long-term retirement and financial advice to federal workers, how is what they need to do, absent the shutdown, different from other kinds of workers? What are the kind of unique things they need to consider?
Yeah, so here at ProFeds, we provide retirement training to federal employees on lots of different platforms. We have our workshops, webinars, podcasts, articles, all sorts of different places where they can get this news and get the information that they're going to need to make decisions. However, the underlying theme of all of our training is that we want federal employees to put themselves in the driver's seat. We don't want them to believe that someone else is going to take care of their retirement future, their financial future. And so a lot of what we're doing is simply helping people to have the right information so that they can get clear on their numbers. Because one thing that's really clear to all of us in the financial planning world is when you know your numbers, your financial decisions become more obvious. And so when we deal with something like a shutdown, when we have a federal employee who may miss a check or two with a shutdown, if that is enough to cause the financial turmoil in their household, we may have bigger problems that the employee really needs to address. And I share this with a tremendous amount of love because we want to help employees to feel empowered to be in control of their situation. But when you don't have emergency savings, when you are literally living paycheck to paycheck, it takes the confidence away from the retirement decisions that you're ultimately going to be making. So we want to make sure that with all the federal employees who are coming through our training and the financial professionals that we train and support to serve this audience, that they have a really clear understanding of the various ways that federal employees are unique because their decisions are going to be different than the average American that's out there.
And Chris, forgive me, I should know this, but what's the 401k structure look like for federal employees? Do they have that option to contribute to that, or is that plan different than for private sector?
They sure do. Of course, the government has named it something different. They don't call it a 401k, but it is a 401k style plan called the Thrift Savings Plan. And it's actually quite generous. There's a match. There's all sorts of great things that happen with the TSP. But in a government shutdown, the TSP isn't very helpful all that money might as well be locked in a vault in the bottom of the ocean. If an employee needs that money, they're not going to be able to access it during a government shutdown simply because of the rules of the 401k plan. Now, there are some minor exceptions, but that shouldn't be the emergency plan that everyone is running to pull money out of in the event of a shutdown.
Fair enough. Chris, thank you so much. Really appreciate it.
You are very welcome. Thank you for having me on today.
And that was FA Corner, brought to you by Capital Group. Coming up, we got full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst, first up, the government shutdown continues. Will we see a deal reached today? Not looking likely, but we'll talk about it. Plus, we'll take a look at the health of the labor market and what AI skills are needed to succeed. And Taylor Swift unveils her highly anticipated new album. What will the economic impacts look like this time? We'll discuss that and more on Market Catalysts. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here. As we look at the major averages, we have been seeing some strength here today, even after we got an we don't have the government jobs report today, but we did have a report on services, the services economy from the Institute for Supply Management that did show some deterioration in the headline number and an uptick in prices, but that's not slowing down the rally. The Nasdaq up about 0.2%, coming back from an earlier small decline. The S&P up 0.4%, and the Dow gaining about 400 points here. The first government shutdown seen in nearly 7 years has entered its third day. Lower-level negotiations have failed to strike any deal, but the Senate is expected to vote on a temporary funding bill today. For more on what we can expect, let's bring in Yahoo Finance's Ben Worschel. Ben, not seeing much light at the end of the tunnel here.
For sure, yeah. As you mentioned, there's another Senate vote scheduled today. This is on both a Democratic and a Republican plan. The thing to emphasize is this is actually try number 4 at these two plans. They voted, this will be the third vote this week, and then there was another one a couple weeks ago. So far, the tally is 0 for 3 in terms of reaching that 60 vote threshold on either of these plans. The widespread expectation here in Washington is that we're going to be 0 for 4 in a couple hours' time. Those votes begin at 1:30 and should take about an hour or two. After that, it looks like senators are going to head home for the weekend, and the focus is going to turn towards Monday, basically as both sides keep digging in. The White House, for their position, is arguably turning up the temperature by kind of canceling high-profile Democratic projects. The latest one this morning is $2.1 billion, a hold at least on $2.1 billion in Chicago infrastructure funding. Chicago and its the Democratic leaders in Illinois have long been a target, of course, for Donald Trump. So that's the latest from Budget Chief Ross vote this morning. Democrats, meanwhile, are kind of making the calculation that increasing voter focus on issues like healthcare and potential economic effects could increase the temperature on the Republicans and force them to have some sort of negotiations. But again, we're looking more and more towards Monday for when both the House of Representatives and the Senate will be in town. This will be the first time in a couple of weeks where everyone's been in town when actual negotiations or a way out of this might be in the offing.
And Ben, you mentioned the other day that the White House, if not put out, at least had retweeted some of these sort of deep fake memes about the Democratic leaders. The sombrero on Hakeem Jeffries getting a lot of attention, but also the words they put in Chuck Schumer's mouth, highly problematic. I think it's safe to say. Are we seeing any kind of talk of those high-level negotiations again, or is that kind of taking that off the table?
Yeah, no plans, at least for now, in terms of a White House involvement in this. I think the Democratic calculation here is that Trump needs to be involved if they're going to put healthcare on the table, and they're going to talk about that. But these memes, these sort of videos that Trump is posting, not only are they not apologizing for them, they're doubling down. They actually replayed a lot of these sombrero videos in the briefing room. They just put them on a loop on the TV in the briefing room. So they're not unhappy about that. And then there was new videos that Trump posted overnight, one of which had Ross vote as the Grim Reaper for Democratic programs. So they're clearly not backing away from this. But the question being sort of, do Democrats back down first, or do Democrats force a kind of some sort of at least negotiations starting next week at the earliest?
We'll see. Ben, thanks so much for keeping us posted. Well, the Congressional Budget Office estimates the government shutdown is costing the U.S. $400 million a day in back pay. Meanwhile, the president met with the head of the OMB to discuss potential cuts to the federal workforce. Joining us now, the former director of the Congressional Budget Office, Douglas Holtz-Eakin, alongside Gene Sperling, former senior advisor to President Biden and national economic advisor under Presidents Obama and Clinton. Gentlemen, thank you so much for being here. Doug, I find these sort of entrenched positions fascinating here, and it doesn't seem like there's any sort of movement. What are you watching most closely here as this whole thing unfolds?
Well, I think this looks like previous shutdowns in that, everyone's pretty entrenched, as you said at the outset. That there's not a tremendous interruption in government services. A lot of essential workers are doing their job. There's not a tremendous economic disruption. And so there's no great pain on either side. And as time goes on, however, that pain starts to go up. And I'm watching for the point where people, can't get their passports renewed. They have all sorts of nuisance interruptions in their lives, and they start to complain to their congressman about what's going on. Then you start to see movement. And thus far, we've seen nothing like that.
Right, and we'll start to see if there are TSA sick-outs, for example, like there have been prior shutdowns. This might be like other shutdowns in some ways, but Gene, on the flip side, I think the memes are new. The deepfake videos are kind of new, right? The threat to permanently fire workers is new. So what does that inject into the proceedings?
Well, I think right now you've got a little bit of Democrats focused on health care versus Republican White House focused on hardball. And, the Democrats believe that they have a winning issue, which is that when President Trump and the Republicans extended expiring tax cuts, they left out one. And that one is the enhanced health care tax credit for premiums. And they feel that it's going to go up in the next month or so. And so they're going to have a winning issue, which is that the president is shutting down the government to avoid giving 22 million Americans their health care tax cut, or put the other way, 22 million Americans and working families who will see a serious cut. So they think their message is going to work and they're going to prevail. And there's some signs that the White House and their pollsters are worried. President Trump is doing, I think, less message than more hardball. He's, hoping Democrats will cave. And he saw 3 dissenting votes. So he's thinking he's inflicting pain. He's forcing mass firings. I think it's a risk when he does this because I always say you kind of win a shutdown if you both have the substantive issue that works, which I think Democrats do, and you look like the reasonable one who's trying to get back. You see Senator Thune and Speaker Johnson trying to do that when the president's doing AI sombreros and threats every day. He's taking a risk of losing the public more. But I think, again, he's doing less messaging and more hardball and hope Democrats will just cave.
Well, Doug, I'm curious about your take on this because on the one hand, Democrats were under heavy pressure from their constituents to do something, right? To do some kind of gesture of resistance against what the president has been doing. But does this feel like the one that is going to land?
So this is how it plays out, Julie. I mean, if you use logic, then, this doesn't happen because it's clear that Republicans have passed a funding bill out of the House. It's Democrats in the Senate who refuse to support it. They shut the government. In fact, it's the same thing they voted for in March. So they got the I did it and now I'm not doing it problem. That's all logic, but that's not what's driving this. This is driven by deep emotion, the base of the Democratic Party being frustrated with what's going on, wanting to make a show of standing up against the president, and the leadership saying, well, we have to let them do this. And so when those emotions play out and people return to the notion that, well, we can probably get these premium tax credits in some sort of omnibus spending bill, but we'd have to get the government running again to do that, then they will open the government back up and we'll see the negotiations.
But at the same time, you see, there's sort of a drip here. The latest being the Trump administration reportedly withholding $2.1 billion in funds from Chicago. Here in New York, it seems like we're not going to have access to $18 billion to do Hudson River subway or tunnels, rather. Doug, so do as there is that chipping away at things, how's that going to affect the public's view of all this?
That's a really good question. I actually don't know the answer to that. That is the new thing. There has never been a president like President Trump who takes this opportunity to say, okay, let's just poke the Democrats every way we can think of it. Let's run banners on government websites. Let's cut off their funding for the projects in their districts. Let's threaten mass firings of federal workers. We haven't seen that before. And I thought the Republicans were in very good shape and had a very clean message, and Democrats didn't. And then they started these things. We'll see how it plays out.
Is that okay, Doug? That like the out of office messages that people, if you email a government worker, you get an out of office message blaming the Democrats?
Look, this is not the way. Number one, I don't think shutting the government's a good idea to begin with. Period. Let's just be clear about that. It's more costly to start it back up than to just keep it running. So there's no logic to that. This kind of sort of trolling of the Democratic Party is a signature of this president. It's not something that I certainly personally would do.
Gene, the thing that everybody seems to agree on is that we don't like doing this every 4 years. The public certainly doesn't enjoy this whole rigmarole. The markets at this point largely shrug it off. How do you break this cycle of this happening?
Well, I think, as Doug said, you've got you've got a president who is using very hardball, often legally questionable tactics, both in, I don't want to use an overly technical term like pocket rescissions, but seeking to cut spending on his own in various different ways. So you have a lot of Democrats thinking, why are you compromising with their colleagues on the Hill when he's just going to cancel it? Anyways, you also are having an appropriations fight right after you've had a budget bill where things have changed. So while I think I understand the Democratic instinct to fight and show they're tough, they're going to do well to the degree they're disciplined. So, for example, if they try to ask for everything under the sun, every wish list, they will become the unreasonable party. And I think that will strengthen President Trump's hand. But right now, they're being pretty disciplined. They're focusing right on something very recent, which is the coming expiration of healthcare tax cuts that help lower premiums for millions and millions of Americans who are clearly working Americans. If they stay focused on that and the public starts to think that President Trump is overplaying his hand, he starts looking like the unreasonable one. So it's always a tough battle. You have to stand tough for what you believe in, but that's got to be something the public's with you on, and you have to be able to do it while you still look like you're the reasonable party. At this moment, I would say the Democrats are probably playing their cards better because they're staying very focused on the healthcare premium. They're not talking about everything. And President Trump's probably making them look more reasonable just by the hardball tactics and the AI sombreros. And I think the polling is starting to show things are a little better for them. That does make me think, as Doug, I think, was suggesting, that there's really no reason this has to be a super long shutdown. I think the White House is going to have to give on the substantive issue, but perhaps they can find a way to do that saves some face. They promise a vote on it. So I'm not super pessimistic. This goes on and on forever, right. but we're watching real time who's emerging and getting support with the public.
Yeah. Doug, Gene.
Just want to pick
please,
up
Doug.
One thing you said, which I think is right, with a slight variation. I think the key here is Majority Leader John Thune. I don't think the Democrats are going to trust a deal made with the president at this point. But if Mr. Thune promises them a negotiation and a vote on the health care credits, they can come back and negotiate. So I keep my eye on him.
See, look at this. We can have a civil conversation with people from different sides.
Yeah,
of the aisle.
we're a bygone era.
Let's bring it back. I would love that. Gene, thanks so much, guys. Appreciate it.
All right, thanks.
Coming up, we look at how AI is affecting the job market. That's next on Market Catalysts. 71% of Americans worry that AI will lead to permanent job loss. That's according to a recent Reuters Ipsos poll. According to the data, though, that isn't necessarily happening. The labor market has remained pretty stable, with the share of workers that are in jobs highly exposed to AI holding steady, as according to a different survey from the Yale Budget Lab. Our next guest has insight into how AI is changing the job market. We've got Allison Srivastava, an economist at Indeed. Allison, thanks for being here. So there is all of this sort of confusion and debate, and there's sort of anecdotal stories, but then there's what's really happening. What's really happening? How, especially for entry-level workers, how is AI transforming or not the job market?
So I think what's really interesting about the report that we looked at for AI in relation to jobs is that we took it as a set of skills, right? Rather than jobs, whether or not they'll be taken by AI or adopted. You can think of a job as a set of different skills, and some of those skills can be handled by Gen AI pretty well, and there's others that really can't. And so I think that thinking about things in terms of what skills can you leverage as a person and which skills can you really use AI to leverage and show that you can adopt both.
And so what did you all conclude then as a result of looking at it as skills-based?
So there is quite a big variation across sectors, but about 46% of jobs have some kind of hybrid integration. So AI is certainly going to impact your job, a lot of the skills within your job, but not necessarily take your job in whole. And so trying to figure out, what sets of skills within your job can be outsource, as it were, using Gen AI, as opposed to where you really do need that human touch, I think can kind of help you navigate that fear around AI in the job market.
And so, for people who are out there looking for jobs, what advice, could they draw from this study as to what they need to do, what skills they need to develop, whether that be AI or some of the so-called soft skills?
So I think that this is where, people have a really big advantage because AI is pretty new, right? It's not really worked into a lot of course curriculum. So a lot of the training that you can do to adopt AI skills and have employers really accept those AI skills can be done at home, can be done independently. So I do think that there is an opportunity there for people. If I were on the job market today, I'd probably be looking at where can I really integrate AI into everyday tasks, improve that. So even things as simple as helping write emails or annotating notes from meetings, showing that you are adaptable, that you can change with the times and really use it, but still show why it's important for you to man the ship, as it were. We know that Gen AI isn't nearly as adept at making problem-solving decisions or networking. So I think of AI adoption in really that twofold.
What are the skills? I mean, we're looking at it right now, actually. This is answering my question I was going to ask you. The jobs where we could see the highest level of transformation. Talk me through those.
Sure. So these are going to be jobs where there's not a lot of in-person interaction and, a lot of more repetitive tasks. The reason why insurance is a big one is because, it's a lot of filing, filling out forms, a lot of that more in-office work. And that does definitely have a higher probability of having, more of a hybrid approach.
Well, and the hybrid, I think of also medical professions, law professions, where we have started to see AI assistants reading x-rays, for example, if I take the medical, or if you're writing a legal brief and you're using AI to help you do the research. I guess this is all just about people learning to use those tools in their jobs to be better at them.
Learning to use those tools to be better at your jobs and also showing why you are still needed. If I were, say, as an economist, I'm going to be focusing on, I can have AI help me problem solve some code or something like that. But really being able to interpret labor market data and show why it matters, that's something that, I'm going to be leaning into as an economist, is like, this is more of a human skill. And I think that most people's jobs kind of have that twofold approach, that you can really look at what can Gen AI help me with and what can I prove that a human really is necessary for this task.
Allison, finally, on Indeed, are you all seeing any reduction in listings for entry-level jobs? Not necessarily that the jobs would be eliminated by AI, but maybe companies are hiring fewer people because AI is making the people who are being hired more productive.
We recently looked at jobs that have senior versus junior titles, and what we found is that while junior titles are decreasing, they're not really decreasing more than job titles overall. It's really hard to disentangle because we have a cooling labor market. So, really being able to say this is because of AI and this is because of labor market cooling, that's going to be incredibly difficult. But where we're really seeing right now is that it's more of overall labor market cooling. It's overall that because we have a really frozen labor market, trying to get into the labor market for the first time, especially if you are a new graduate, new high school graduate or college, you're probably having a really hard time breaking in because there aren't that many opportunities.
Allison, thanks so much for your perspective. Appreciate it.
Thank you.
Coming up, we'll get you some trending tickers and a market check. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ. Let's get a quick check of the latest market action. We're about 2 hours into today's trading session. And what we're seeing is all three major indices really see ongoing momentum here. All three major indices in the green this morning. The Dow is leading the charge, up about 0.7%, followed by the NASDAQ, which we saw start the morning flat, up about 0.3%. And the S&P 500 also moving higher, up about 0.4%. And keep a close watch on the S&P 500. Of course, this is the first week of trading, the first week of Q4, but we're also in the midst of this third day of the government shutdown. And what we've seen in years past, the last government shutdown being 2018, is really this ongoing momentum and growth within the S&P 500, with markets largely shrugging off anything that we're seeing in DC when it comes to a shutdown. As much as 10% returns is what we've seen in the past around the S&P 500 by year end. And so certainly keep a close watch on that. I also do want to take a look at the 10-year Treasury yield. We are seeing that move just a bit higher, now hovering around 4.11 as we make our way into today's trading session. Also, the 30-year yield up just slightly, sitting around 4.7 as well. But gold futures have been seeing quite the momentum year to date. Gold futures are up nearly 50% now, and we're seeing that momentum continue this morning. Gold futures up around 1% after a bit of a pullback, just ever so slightly. We'll keep a close watch on that as strategists are making some year-end targets, and by year-end or rather middle of next year, 2026, something like even 5,000. Right now we're sitting around 3,900, but that's something to watch as well. And lastly, I do want to take a look at Bitcoin as well, because Bitcoin did cross 120,000 yet again. That's ticker BTC-USD. Now we're seeing some upward momentum, up about 1.5%, sitting around 121,448, and that has seen some momentum. And as for a reporting on Yahoo Finance that October is a key trend, with 10 out of the 12 past rises in October. Some momentum there, seeing at the early innings of this month. But keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout today's trading session.
Now time for some of today's trending tickers. We are watching Palantir, AI stocks more broadly, and pharma stocks. First up, Palantir. A few items moving that stock today, including a push to end use of the software in Denmark and an army memo. Joining us now for more, Yahoo Finance's Ali Canal. So lawmakers in Denmark, we've seen in different places voices push various entities to stop using Palantir for various sort of political reasons.
Yeah, and it also stems from what Denmark, the government there, is calling privacy concerns. And they really want Palantir to share their source code. Lawmakers there are passing a motion urging officials to, quote, commit to purchase or develop fully fledged alternatives to Palantir and demand that Palantir disclose that source code, saying regulators have no access to how the software handles citizens' personal data. So that's something that Palantir is dealing with from the Dutch parliament. And then you mentioned that Army memo, and this is an internal memo first reported by Breaking Defense and Reuters, and it called the system a very high risk system, and it warned that enemies could gain undetectable access to sensitive data. That's not something you want to hear from a company that really has centered itself on data and defense. The report saying that authorized users could see all applications no matter their clearance level, and that some outside apps weren't properly vetted. Now, Army officials saying that this is all part of the normal security review, but investors clearly taking that in combination from what we're hearing with Denmark, and you're seeing shares down around 4% today. But I will say, year to date, we're up over 140%. So longer term, it feels like people are still bullish on Palantir. There were those question marks of whether or not this was a company that operates like a meme stock, but I think at this point, there's enough bulls out there that make the case that this is a company that you should be taking seriously.
Well, yes, taking seriously, maybe. Buying, maybe that's another question. But it is interesting that, the report, that Army memo, the push to modernize the military, they have been really front and center in that. So.
And it's the system's designed to connect soldiers, vehicles, and commanders in real time. And it also involves other players, Microsoft and Anduril.
Yeah,
so
interesting.
It'll be interesting to see how this develops, and I guess if this eventually gets cleared too.
Right, yes, good point. And speaking of Palantir, by the way, we are looking at AI stocks more broadly. There is a conference going on in Italy where a lot of various CEOs are speaking, among them Amazon founder Jeff Bezos, Goldman Sachs CEO David Solomon, and they're both addressing the question of whether the AI trade is in a bubble. Some really interesting stuff coming out of that.
Really interesting, because a little bit more of caution, I would say, than what we've heard from even some of our guests on this show. You have Goldman Sachs CEO David Solomon saying that investors may be overlooking things to be skeptical about, saying that markets could see a drawdown in the next year or two as capital flows into projects that, quote, don't deliver returns. Now, this is something we've been discussing, because even if you look at OpenAI, which is the most valuable private company now, doesn't turn a profit. So that's some
not only does it not turn a profit, it's like way far from turning a profit.
Yes, and that is what some investors and market watchers have flagged when it comes to potential bubble risks. And then to that point, Amazon founder Jeff Bezos called this a possible industrial bubble. He did say, though, that AI is real. It's going to change every industry. But right now, you have a lot of money that's chasing anything that AI touches, whether it's good, bad, profitable, unprofitable. And that is the concern here, that we're maybe getting into levels that are potentially just a bit too frothy. So this is something we've been tracking, we've been talking about. There is a lot to be said when it comes to the earnings momentum that we've seen from some of these companies. And then on the productivity side too, I mean, AI, you continuously hear it, that for GDP growth, that is going to be the thing to watch.
We keep hearing it.
We keep hearing it.
I'm really curious to see what, because we all also, as we talked about earlier in the show with the guest from Indeed, like we're getting some conflicting sort of how it's affecting the job market, for example.
Right.
And so I think it's still a little bit TBD on the macro level.
Yeah, and the timing, right? Like how long will investors have that patience until we start to actually see those returns, and it's not just growth at all costs?
Looks like they're pretty patient so far.
They're pretty patient so far. I mean, we look at the NASDAQ, look at all those
starts, but still, yes. All right, let's talk about pharma stocks as well. Poised to cap off their best week in 16 years as a drug pricing and tariff deal with the U.S. government helped ease an overhang that's been weighing on the sector. Pfizer sort of kicking it off, and that creating a lot of hope for the other stocks.
And Pfizer serving as the blueprint for what this deal could look like. And Pfizer essentially promising to cut Medicaid drug prices in exchange for a tariff reprieve of at least 3 years. They also are planning to invest $70 billion here in the U.S. And this is something the Trump administration has been pushing for, not just with the pharmaceutical sector, but the larger tech sector as well. We've seen him cozy up to CEOs like NVIDIA CEO Jensen Huang, Meta CEO Mark Zuckerberg, and those companies have committed hundreds of billions of dollars back into U.S. investments. It seems like Eli Lilly is the next pharma company that the White House is targeting here. So again, just takes the worst case scenario of tariffs off the table. That's leading to a boost in some of these pharma names. You got Pfizer, Merck, Lilly, all surging double digits this week, each posting their biggest weekly gain since 2009. And analysts saying that if more companies follow Pfizer's lead, this could ease a lot of those pressures that we've seen when it comes to tariff and drug pricing headwinds, something we've really been talking about all year.
Yes. Thanks so much, Ellie. Of course. Appreciate it. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, mortgage rates rising for the second straight week, even as the Fed has begun its rate cutting cycle. Still, rates do remain near lows for the year. Yahoo Finance's Miles Udland spoke to Michael Frantantoni, chief economist for the Mortgage Bankers Association, about the outlook for the housing market.
Over the last month, we saw mortgage rates reach the lowest level we've seen this year, down into the low sixes. It really stimulated a pretty profound jump in refinance application volume. So those homeowners who had gotten a mortgage over the last couple of years really sensing that opportunity. But then, as you said, over the last couple of weeks, rates drifted up again. That refinance volume has fallen off. But I think for those looking to buy a home right now, there's a lot of positive news. One is, again, mortgage rates are relatively low compared to where we've been the last 3 years. But two, and probably more important, there are a lot of homes out there available to buy, and that's a very different picture than what we've seen the last couple of years.
Yeah, let's maybe decompose that as you outlined it there, and let's talk about, let's start with the home buyer part of the market. And as you guys see it, how much pent-up demand is there really in that market? And, you know, to what extent does finally getting, goodness, a 5 handle maybe on the 30-year at some point next year, like how does that in your mind and your team's work show like what the unlock could be in terms of folks that have been waiting on the sidelines as a result of rates, really saying, okay, that's my number, I'm in, and you know, you've got lines out the door at open houses?
Yeah. So you start with the first-time home buyer, right? So there are 50 million people in this country right now between the ages of 30 and 40. So really at peak first-time home buyer age. It's been a challenging environment. I mentioned the move from a really tight inventory environment to one where homes are more available, but affordability is still a challenge, right? Obviously, home prices did increase a lot before now really stabilizing. And we went from record low mortgage rates during the pandemic to rates, touching almost 8% at one point. So it's been a challenge for those first-time buyers, but I think that's where a lot of the pent-up demand is. Beyond that, the move-up buyer, the lock-in effect has been talked about a lot, where someone who got one of those record low mortgage rates back in 20 or 21 has just been reluctant to move. But over time, more and more life events happen. People have children, get married, get new jobs. Lots of reasons why they might be ready to sell and move to that next home. So I agree with you. I think there is a lot of pent-up demand in the market, and this latest drop in rates might be enough to spur people to buy, even though in the fall you generally see a little bit less activity than the peak time during the spring.
And then that refi piece of the market, how quick have we seen folks be, to go ahead and start the process to refinance with the move lower in rates? It feels like it's been a very sensitive number. I don't know how, if this is anomalous in the broader context of, how this market usually moves. But it felt like the second you started seeing that 30-year under 6.5, people couldn't get to a refi fast enough. Is that kind of what it felt like to you?
That's exactly what we saw in our application data, where, exactly at that moment where rates started to drop, really reflecting some of the weaker job market. Again, the expectation that even short-term rates directed by the Fed might move lower. You had a lot of people all of a sudden very aware of the opportunity they had. Again, folks who got an initial mortgage between sort of middle of 2022 and middle of 2025, they had seen rates, up to a percentage point or more higher than what we see in the market today. So really substantial opportunity to lower their monthly payment.
And then thinking about the housing market broadly, I'm curious what, from your seat, it looks like in terms of the bifurcation, both in terms of the home price that we see, how willing buyers are at certain price points. It seems like we see triggers depending on the market. And then, as I got to there, the geographic bifurcation that we've seen where certain markets have been tight, they've been strong, there's really been no weakness, whereas others, it's been, year 3 really of a much softer environment.
Yeah. On the geographic point first, in those markets, particularly in the South and the West, where builders have been much more active putting up new construction homes, we've seen inventory levels rise pretty quickly and really above sort of more balanced levels. So you're even seeing some price declines in some of those markets. Just think of sort of the Sun Belt markets as a catch-all phrase. But if instead you look in the Northeast or the Midwest, where you didn't have as much new construction, prices are still growing and certainly have held up to a much better level. So it depends on where you are, and then also depends on sort of where you are within that price range. So as always, sort of entry-level properties, the market tends to be a little more competitive than if you get into the middle of the range or at the high end of the range in terms of home prices.
Now, I'll leave you on this one. We've seen a little bit of an uptick, nothing notable, but something that you could point at around the use of arms. I think it makes some sense in some situations, right? I think it's a safe-ish bet to say rates are probably not 6.5% in 5 years, depending on exactly how you do that. What have you guys seen on that front? Do you have concerns around this, or is this the kind of thing that, a mortgage banker is saying, hey, we can be a lot more creative with your financing options here than just having to say, do 30 or 15?
Yeah, no, great question. So our data showed the ARM share, which had been as low as about 3% a couple of years ago, is now sort of low double digits, somewhere sort of 10 to 12%. ARMs are different today. If you think back before the great financial crisis, ARMs were really short-term instruments where you'd only have your initial rate locked for a year. Now, the typical ARM that a borrower would get, the initial fixed rate is for 5 years, 7 years, 10 years. So that may be longer than they're planning to be in the property.
Government data just went dark, but money never sleeps, as they say. In today's Stocks in Translation, we're going to show you the playbook that keeps traders moving when the big jobs and inflation reports are on ice. And here are the major holes that we've got to fill. The BLS delivers not only the big monthly jobs report, but also inflation measures like consumer price and also producer price inflation. Meanwhile, the Census Bureau's retail sales, durable goods, and new home sales and factory orders, they're also on hold. Add to that the BEA, which calculates GDP, personal income and spending, as well as the PCE inflation gauge that the Fed likes. But there are more. The weekly jobless claims report is also going dark. Now, let's walk the proxies. On the jobs front, monthly private payrolls from ADP, it's a big one. In fact, we just talked to RSM chief economist Joe Bruce Willis on the Stocks in Translation podcast, and he said,
the Fed's got a much more difficult degree of landing because, believe it or not, the Fed gets a weekly update of the ADP estimate.
Oh, interesting.
They do. Most people don't understand that. So the Fed's not flying blind when it comes to the labor market.
There's also high-frequency shift data from Homebase, job postings from Indeed, and layoff color from Challenger. Then for prices and inflation, the Institute for Supply Management, ISM, and S&P Global both publish prices paid numbers, which help give direction. And online price gauges like the MIT Harvard Billion Prices Project, rents from Zillow, gas prices from GasBuddy, and e-commerce data from Adobe, together they help build a picture of price pressure. But Joe tells us that the Fed still has its work cut out on the prices front.
Inflation's a little bit more difficult. They're probably going to be talking to the MIT Harvard Billion Prices Project, and to get an idea of what's going on. There's a whole host of alternative data that we're all going to be talking about for the next number of years.
Exactly. And when it comes to spending and demand, we've got credit card spend from B of A and JP Morgan Chase, Redbook weekly same-store sales, and open table seatings. Then for manufacturing activity, there are the purchasing manager indices from ISM and S&P Global. And for shipping and logistics, we have the Cass Freight Index, reports from the Port of LA, Long Beach, not to mention TSA checkpoints. These are your week-to-week thermometers. But we also have market-based data that you can find through the tickers on the Yahoo Finance site, as well as the app. And for big indices, you can measure the S&P 500, the SOX, which is the Philly Semiconductor Index, the Dow Transports, as well as the NASDAQ Bank Index. Then for interest rates, we've got them across the yield curve, from the 13-week T-bill rate to the 30-year T-bond yield. And with volatility historically rising this time of year anyway, keep an eye on the VIX for stocks, the ICE B of A Move Index for bonds, plus OVX and GVX to measure oil and gold volatility, respectively. Finally, there are hundreds of new ETFs, and many of them measure wonky market stats. LQD and HYG measure investment grade and high yield corporate credit, for instance. And I like to take the price of IEF and divide it by IGIB as a measure of credit stress. When it goes up, that means investors are preferring the relative safety of U.S. Treasuries over corporate bonds. So now you've got the tools, let's avoid the traps. First, focus on direction, not one-offs, especially with higher frequency releases on narrower data sets. It takes 3 prints minimum to make a trend. Then try to cross-check at least 2 independent sources. Are they saying the same thing or are they disagreeing? And always understand the methodology. Wonky things like sample bias and revisions can bite you. And finally, track the release times. Volatility will cluster around these drops, and the lack of big reports means that market seasonality itself will be affected short term. Bottom line, a data blackout doesn't mean you're blind, but until Uncle Sam turns on the lights again, we might have to work a little smarter. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Taylor Swift's new album, The Life of a Showgirl, is out now. The release included midnight sales at Target stores, a launch party at movie theaters around the world, even pop-up experiences. The album expected to rake in millions in sales. The megastar's last album, The Tortured Poets Department, sold 2.61 million units in its first week in the U.S., according to Billboard. Joining me now to talk about the business of Taylor Swift, Marcus Collins, University of Michigan Ross School of Business marketing professor, and Juliana Kaplan, Business Insider Senior Labor and Inequality Reporter. Thank you both for joining me. Obviously, the business of Taylor Swift is big business, as we learned from the Eras Tour and the last album. Juliana, I want to go to you first. What are your expectations around this one, particularly? This is a little bit different, right? This is a different era, if you will, for Taylor Swift, right? She's bought back her masters. She, at least right now, is not planning a tour to support this album. So how are you thinking about this one and what its reception and its economic impact is going to be?
Yeah, I think it'll be an interesting one. I think we'll probably see the economic impact showing up more in merch sales. Obviously, we're going to head into the holiday season too. She was doing this collab with Target, as you mentioned. And I think we're also already seeing sort of a different concerted marketing push as well. Before the Eras Tour functioned as real-time marketing, essentially, especially for the Tortured Poets Department, where she incorporated a whole set into that. Already, we're seeing her doing quite a few interviews and media hits, which has not happened in several years for a Taylor Swift album. So in some ways, it's actually going back to a more traditional sort of marketing economic impact style of album release, right? That you might see from an artist who isn't Taylor Swift, which I think is interesting to see how that will play out, considering just how huge she's grown and how, almost distortionary bubble the Eras Tour effect was.
Marcus, as somebody who studies this stuff, I'm really curious on your perspective on how Taylor Swift did this, right? How did she build herself into this marketing juggernaut? What were sort of the key steps that made her different from other artists out there?
Originally, I would say that Taylor focused on her fans. She's had hit records for a long time, well over a decade. And even though she had records that would justify her doing really, really big tours, instead she did big artists in small spaces in an effort to facilitate relationships with her fans. This is all about proximity, intimacy. So when Taylor decided to do a very big tour like Eras Tour, she invited all those people that have been descending around the campfire in community with her based upon the way she sees the world to join her in this celebration of all these many eras in which she had come to market. And I think that Taylor Swift has played the long game. Instead of being focused on how can I succeed today, it's been how do I plant seeds that will blossom later on. We've seen this in her Easter egg approach when she brings products to market. We've seen it in her partnerships, even in her songs. It's always a nod and a wink for those who are close, those who are in the know, are able to see the things that people do not, rewarding them for being in community with her. This has been Taylor Swift's entire approach. She doesn't have fans, she has Swifties. And these Swifties feel like they're a part of something bigger than just Taylor Swift, the artist, but in this universe that she has created for herself, which has made her been not only just a powerful entertainer, but even a powerful brand.
And to that point, something, Juliana, that I know you've written about is her quest to buy back her masters and the fans feeling like they were part of that effort also.
Yeah, I think that was, again, a huge marketing savvy move, but also she's sort of revealed that behind the scenes, the support from the Eras Tour, the support of the re-recordings directly impacted her ability to actually buy back these masters and do this sort of huge financial coup. And I think to Marcus's point, that really had Swifties almost feel like they had an equity stake, right, in the business of Taylor Swift. That she really intertwined sort of this like emotion and commerce into, you know, her art and her early art as well. And that was also something that in the Eras Tour too, there's this way of people being like, well, the way to ethically consume Taylor Swift is, you know, seeing her perform her Taylor's version live, streaming the Taylor's version as well. And now they're able to also go back to that back catalog and feel as though they have ownership in it as well. And this is her first album that's coming in this post sort of Masters era, which is interesting because that has been like a very stated goal of hers for however many years. So this is the first album that's created not really in the shadow of this whole body of art not belonging to her.
And so, Marcus, let's look forward for, you know, sort of current and forward for Taylor Swift as she has created this community that you talked about. As Juliana pointed out, she's doing this a little bit differently. Her media tour, a little bit like a more traditional media tour. But what do you think we should look for her, and what do you think that also augurs for the economic impact this time around when it was so huge because of her tour around the world?
I like the way Juliana put this is going to be sort of a return to fashion for her. I think we're going to see some new media approaches, but very much rooted in sort of the pre-existing ethos of how we bring things to market. I mean, it's no surprise that she's working again with Max Martin and Shell Back, the same producer she worked with for Red in 1989. So it's a familiar feeling, but yet she launches or at least releases or announces the new project on a podcast that normally isn't a way by which artists go to market. I think it's this tension between old and new is sort of what we're dealing with here. We've got a new Taylor Swift. She's happy. She's in love. This is great. This is a new Taylor Swift for us. But yet there are some old hatchets that she's not willing to bury with some detractors that she's had along the way. I think this old and new is what we're going to see with regards to how she navigates in the market and the impact it's going to have economically as well.
Marcus, Juliana, thank you so much. Appreciate your time.
Thanks so much.
That's it for Market Catalyst. I'm Julie Hyman. Keep it right here.